Welcome, Aftermarket suppliers, to the road ahead. I am Paul McCarthy, President and CEO of your MEMA Aftermarket Suppliers, and the road ahead is our quarterly newsletter to bring you our latest thought leadership. While our Aftermarket Weekly that you get, that helps you stay on top of your MEMA Aftermarket membership benefits, the road ahead is here to keep you informed on what we're working on to ensure your success as suppliers. So, that's from updates on advocacy efforts, especially Right to Repair, to the latest from our networking groups and events, to our industry insights and analysis, and even more. So to kick off the road ahead, I will typically bring on one of my team members to talk about an area of insights or value that we're bringing to you, our members. And this time it's a subject that's frankly not so positive: the impact of higher interest rates on aftermarket suppliers. So with me here today is Philip Atkins, our Director of Industry Analysis.
Thank you, Paul. And yes, let's talk about the impact. Our industry is particularly sensitive to interest rates. And when they get this high, it can get really painful. Why? Because of extended terms of up to 360 days. And these are common with the big aftermarket retail customers. And nowadays, we fund them with so-called reverse factoring based on our customers' credit rating. So these interest rates make it tough today, but this is not a brand new story, is it, Paul?
That's a good point. As far back as 2012, we did a landmark study with KPMG on the concerns and threats related to extended terms in the automotive aftermarket sector. And you've heard me raise this topic many times in our advocacy on behalf of the supplier community.
And if you will, let me mention a couple of key findings from that study that still hold true today. The study made clear that our industry's payment terms are unlike any other industry, and not by a little. In fact, it's usually by multiples. For example, while we are paying 360-ish days, in most industry, 90 days are considered highly extended terms. And then there's a second key finding, which is, given our industry's unique model, interest rates should be considered just another cost factor, no different from increases in other input costs, such as steel, oil, or shipping.
Exactly, Philip. And our customer CEOs, including from our vision stage, have supported that point of view, though we know we haven't always seen their purchasing folks reflect that fact. There's another shift that's making this issue even more important, isn't there, Philip?
Yes, and this is not the fault of our distribution partners or anyone really, but interest rates are up dramatically. And if you're thinking high rates are only temporary, well, it is becoming clearer that higher interest rates are not a passing fad, and they won't pass even after inflation is under control. Economists and the customers are telling us to prepare for an extended period of higher interest rates. The low rates we enjoyed previously might never return.
Ooh, well, that's very different than the rules of business we've had the last 15 years, because reverse factoring was frankly an attractive funding mechanism for many in the automotive aftermarket in this time of historically low interest rates. But higher rates have created a material negative financial impact for many aftermarket suppliers. And frankly, the degree of margin erosion for the supply base means that we cannot bear this burden alone.
And to that point, I have a couple of examples, Paul. A member's recent quarterly earnings report missed consensus by 20 cents, and these higher rates were a major part of that miss. So these rates took the top off of what would have been a pretty good quarter. Now that's the members' point of view. Here's the view from Wall Street, from Brett Jordan of Jefferies specifically. Following the historically fast and still continuing rise in interest rates starting in early 2022, supplier margins have been significantly pressured as climbing factoring costs continue to inflate SG&A expenses.
And what's key here is this shouldn't be a point of conflict between suppliers and customers. We don't want those. This is just an economic reality we need to talk about. And it is worth reminding, since I say that every supplier needs to make an independent decision on their terms,
for which we can help. Our general counsel, Aaron Fox Schiff, has provided draft contract language that suppliers may consider using. Now, we've published a link to that language a few times recently in our newsletters, but here it is again below this recording.
So the bottom line is suppliers need to have a strategy around this challenge, and we need to work with our customers on this. And by the way, it's not just terms. This higher cost of money, as we know, is also increasing the cost to carry our inventory and to keep our businesses running. Also, by the way, as some customers have pointed out to us, with some other inflationary factors receding, it's not altogether bad to have some inflation to drive auto parts industry top line growth.
And Paul, we should also mention that we've had some members raise concerns about Chinese companies offering 540-day terms, which are backed by state banks.
Ooh. Well, given that, we should take this opportunity to remind our valued customers on behalf of suppliers to remember that first, any terms over a year do need to be counted according to the accounting board as long-term debt and can affect debt ratios. But also, let's not so quickly forget the goal that our industry decided to diversify supply and build a more resilient supply chain post-crisis. So, a lot of pieces. Philip, can you sum up all of this for us? What's our takeaways?
Yes, this is what we've been talking about, Paul. First, we need to get used to these high interest rates, okay? Then second, in our industry, keep in mind that rate increases should be treated like cost increases in any other input cost. And then third, we have draft contract language that's available for suppliers to use. So those three takeaways, which were true in 2012, they're true today. Suppliers need to have these discussions with customers, and we will continue to make information available to suppliers and share what we know so that they can be considered in those discussions.
All right. Well, thank you, Philip. And I think our key message is we need to work together as an industry to ensure that we do have a resilient aftermarket supply chain. So we hope you enjoy all of the insights from our quarterly Road Ahead publication, not just this, and that includes an update from our government advocacy team on right to repair. One thing that I'm really excited about learning from, which comes from our modern industry expertise, our Mix Future Leaders group. They provided a white paper on aftermarket retail brick and mortar versus e-commerce. And there's also some great insights on sustainability that are relevant to both our heavy duty and our light duty aftermarket suppliers and our remanufacturers in particular, for those of you who missed our last month's MEMA Sustainability Summit. So thank you, everyone, and enjoy the road ahead.